Hi, today let us discuss the application of average clause in loss of profit insurance or consequential loss policy. We have already studied how to apply this average clause in loss of stock. In loss of stock, when you apply average clause, you have to compare two things. That is the amount of the policy and stock at the date of file. If the amount of the policy is less than the stock at the date of the fire, then naturally you have to apply average clause. How will you apply the average clause? The amount of the policy divided by stock at the date of fire into actual loss. That is how we will calculate the claim. And now we are going to study how this average clause will be applied in a loss of profit insurance policy. Now what are the details given and what are the items to be compared in order to know whether there is under insurance or not? Let us see. So we will take an example and discuss the matter. Okay. Now see, date of fire in this example is suppose 1st August 2017 and turnover from 1st August 2016 to 1st August 2017 is 10 lakhs. What is meant that? That is annual turnover. That is the turnover for the 12 months just before the date of fire. The date of fire is 1st August 2017 and turnover from 1st August 2016 to 1st August 2017, 10 lakhs, that is annual turnover. Suppose there is an increase in trend in this year, suppose there is an increase in trend in turnover, that is 20%. In that case, the annual turnover must be adjusted. How will you adjust the annual turnover? That is 10 lakh plus 20% of 10 lakh, 2 lakh. So adjusted annual turnover will be 12 lakh. If there is no increase or decrease in trend, you just ignore that matter. Take the annual turnover as 10 lakh. Now here the adjusted annual turnover is 12 lakh. The next information given in this case is GP ratio. What is the GP ratio? This example 25%. Suppose the GP ratio is 25%. Now policy amount is suppose 2 lakh given. And loss of profit insurance we calculated. That we have already studied loss of profit insurance suppose based on short sales and additional expense altogether constitute loss of profit, actual loss of profit, for example 60,000. Now let us discuss how average clause is applied in this loss of profit insurance policy. Now let us see. Here the policy amount is 2 lakh. We will mark it A. GP on annual turnover. The annual turnover is 12 lakh. The annual turnover in this case 12 lakh we have discussed and the GP ratio is 25%. 12 lakh into 25% we get 3 lakh. That is GP on annual turnover. We will mark it as B. So policy amount 2 lakh A, GP on annual turnover 3 lakh B. Compare it. What do you get? The policy amount is less than the GP on annual turnover. So in order to know whether average clause is to be applied in loss of profit insurance, we have to compare two things, policy amount and GP on annual turnover. If the policy amount is less than the GP on annual turnover, we have to apply average clause because there is under insurance. So in this case, the policy amount is less than the GP on annual turnover. So we will apply average clause. So how claim under average clause is calculated? Policy amount divided by GP on annual turnover into actual loss. So policy amount is 2 lakh, GP on annual turnover is 3 lakh into policy amount 60,000, you get 40,000. This is how average clause will be applied in loss of profit insurance. So when you ascertain loss of profit insurance, you have to calculate short sales as we have discussed previously. That is standard turnover minus affected period turnover, you get short sales. Short sales into GP ratio, you will get loss of profit. Then additional expense claim will be calculated as we have discussed earlier. Then these two losses will be added. You will get total loss of profit. Then if necessary, if policy amount is given, you have to apply average clause like this. I hope you understand the topic. We will meet with a new topic in the next class.